If you haven't watched the first part of economic cycle investing, don't forget to watch it. An economic cycle is composed of 4 phases: growth, slow growth, recession, and recovery. To identify the current phase of the economy, we look into the macroeconomic data for clues. It might seem abstract at first, but MacroMicro's charts and tools have made it much easier to understand. So don't worry and keep watching. The main macroeconomic data that we focus on are employment. For example, there's unemployment rate, and in the US, there's monthly non-farm payroll report. Inflation. Mild inflation is necessary for an economy to grow, and that's why central banks are cautiously monitoring their inflation rate. Profits. Needless to say, the higher the profits are, the better the economy is. The last one is GDP. We use GDP to measure the economic growth of a nation. Based on employment, inflation, profits, and GDP, we can know whether the economy is good or bad. Businesses raise production and hire more people when the economy is expanding. That's when unemployment rate drops and production increases. When people are employed, they spend more. Businesses make more profits too. Strong consumption drives inflation higher, and in the end contributes to higher economic growth. This phase is called growth or expansion. While unemployment rate is still low, businesses stop hiring new people at some point. Consumption loses its momentum because inflation has gone too high up. Profits decline compared to the earlier phase, and economic growth slows down too. This is slow growth. In the next phase, recession, economic growth is weak. When financial crisis occurred in 2008, businesses lay off employees and reduce hours, causing unemployment rate to surge. Consumption weakens because people are uncertain about their future economic conditions. Inflation declines and could turn into deflation. Businesses suffer from losses and go bankrupt. The central bank usually announces an easing monetary policy and interest rate cuts to inject money into the market and to lower financing costs in an attempt to stimulate consumption and investment. As the central bank continues to release funds into the financial market and to reduce interest rates, businesses are more and more willing to invest and hire. The economy recovers at a gradual pace, and the economy cycle rolls on. In the recovery phase, unemployment rate hits a plateau. Inflation and corporate profits improve. GDP growth rises. No matter which phase the economy is in, employment, corporate profits, inflation, and GDP are interconnected. We can identify the economic cycle by monitoring the up and downs in macroeconomic data. In the next episode, we will tell you how to manage your portfolio based on economic cycles.